Today we are looking at Starbucks, ticker SBUX. The brand is still one of the strongest restaurant brands in the world, and the latest quarter finally gave investors some real turnaround proof. But that does not automatically make the stock cheap. The question is simple: is Starbucks really back, or is the market already pricing in the comeback? A great brand is not automatically a great stock. By the end, you will know the fair value range, the price where I would get more interested, and the three numbers that decide the thesis: comparable sales, earnings recovery, and operating margin. This is not financial advice. I'm walking through the numbers so you can decide whether SBUX deserves a spot on your own research list. And if you enjoy stock analysis like this, subscribe to FinanceToGo so you don't miss the next breakdown. So, Starbucks is not a complicated story. It sells coffee, food, and customer habits at enormous scale. The business has company-operated stores, licensed stores, loyalty, brand power, and a global footprint above 41,000 locations. That quality matters. But because Starbucks is already mature, the stock is less about explosive growth and more about whether the turnaround can rebuild traffic, margins, and earnings without asking investors to overpay. The latest quarter was encouraging. Revenue increased 9% to 9.5 billion. Global comparable store sales rose 6.2%. And the important part is that transactions were up 3.8%. That means the quarter was not just pricing. More customers came through the system. Non-GAAP EPS was $0.5, up 22% year over year, and GAAP operating margin improved to 8.7%. That is the turnaround proof bulls wanted. The catch is China. China comparable sales were only up 0.5%, and average ticket was down. North America operating income also still declined. So this is not a fully repaired business yet. The quarter was good enough to matter, but not clean enough to ignore the price. The FinanceToGo score comes out at around 6.4 out of 10. Growth and profitability are improving, but they are not elite yet. Cash flow is solid, and the dividend record helps the shareholder return story. The weaker spots are balance sheet and valuation. Starbucks can carry debt because the brand produces cash, but high debt still reduces flexibility. If the turnaround slows, valuation is the biggest limiter. Around $106, the stock is not priced like a broken business anymore. The price chart tells the same story. The stock has recovered from the lows as investors gained confidence in the turnaround. That is good for momentum, but it also means the easy pessimism discount is gone. If you're building a watch list and instead of chasing headlines, this is where price discipline matters. So let's take a look at the valuation. For valuation, I would use normalized earnings, free cash flow, dividend support, and a premium brand multiple as cross-checks. Management raised fiscal 2026 non-GAAP EPS guidance to $2.25 to $2.45. If Starbucks earns that and keeps recovering, a fair value range around $90 to $110 makes sense to me. The bull case can justify $120 plus if margins and traffic keep improving. But a cleaner buy zone would be below roughly $85 to $90 because that gives more room for China, labor costs, debt, and execution risk. I'm not trying to hit the exact numbers to the penny. I want to know whether the current price gives enough margin of safety. The bull case is straightforward. Back to Starbucks may be working. Transactions improved, guidance moved higher, and the brand still has huge global reach. If service gets faster, stores feel better, and customers keep coming back more often, the earnings recovery can continue. Bears may be underestimating how powerful even modest traffic improvement can be when a brand this large gets operating leverage back. The bear case is also real. Starbucks still has China pressure. labor cost risk, a heavy debt load, and a stock price that already assumes the comeback is working. Bulls may be underestimating how much execution is still required. The thesis breaker is simple. If comparable sales fade, margins stop recovering, or guidance gets cut, this moves from quality turnaround to expensive disappointment pretty quickly. My final verdict is quality, but wait. SBUX is absolutely worth researching, and the latest quarter improved the story. But at around $106, I do not see enough margin of safety to call it a clear bargain. The thesis upgrades it if traffic growth continues, margins recover, China stabilizes, and free cash flow comfortably supports the dividend. The thesis weakens if guidance gets cut or the stock runs ahead of the proof. The investment lesson is simple. A great brand is not automatically a great stock. If you want more stock breakdowns like this, subscribe to FinanceToGo and comment below. Is SBUX a real turnaround from here, or would you wait for a lower SBUX price? This is educational content only, not financial advice.